Welcome and thank you for standing by. At this time, all participants are in a listen-only mode. Today's call is also being recorded. If you have any objections, you may disconnect at this time. I would now like to turn today's meeting over to your host, Ms. Irina Leonova, Chief Capital Markets Strategist. Thank you. You may begin.
Thank you. Again, my name is Irina Leonova. I am from Capital Markets branch of FDIC. And today we will cover the so-called standardized approach for counterparty credit risk final rule that was recently approved by the Board of Directors of FDIC as well as other prudential agencies and published in Federal Register. In today's webinar, we will provide a high-level overview of the derivatives contracts, counterparty risk, scope of the final rule as it applies to risk-weighted assets and leverage ratio, comparison of the current exposure method versus standardized approach for counterparty credit risk method, the new final rule, and we also will look at the determination of replacement cost and determination of potential future exposure. And finally, we will have a walk through the example of the SA-CCR calculation. To save you time and kind of manage expectations, the first 15 slides will be focused on sufficiently high-level overview of the current approaches to derivatives as well as the gist of the SA-CCR rulemaking. And slide 1628 will be focused on an example, a walkthrough step-by-step of how SA-CCR would work in a hypothetical case. Having said that, so let's get going on the high-level overview. In general, derivative contracts represent agreements between parties either to make or receive payments or to buy or sell an underlying asset on a certain date or dates in the future. Parties generally use derivative contracts to mitigate risk, although such transactions may serve other purposes. For example, an interest rate derivative contract allows a party to manage the risk associated with a change in interest rates, while a commodity derivative contract allows a party to fix commodity price in the future and thereby minimize any exposure attributable to unfavorable movements in those prices. The value of a derivative contract and thus a party's exposure to its counterparty changes over the life of the contract based on the movements in the value of the reference rates, assets, indicators, or indices underlying the contract, sometimes referred to as reference exposures. A party with a positive current exposure expects to receive a payment or other beneficial transfer from the counterparty and is considered to be in the money. A party that is in the money is subject to the risk that the counterparty will default on its obligations and fail to pay the amount owed under the transaction, which is referred to as counterparty credit risk. In contrast, a party with a zero or negative current exposure does not expect to receive a payment or beneficial transfer from the counterparty and is considered to be at the money or out of the money. A party that has no current exposure to counterparty credit risk may have exposure to counterparty credit risk in the future if the derivative contract becomes in the money. Parties to a derivative contract often exchange collateral to mitigate counterparty credit risk. If a counterparty defaults, the non-defaulting party can sell the collateral to offset its exposure. In the derivatives context, collateral may include variation margin and initial margin. The latter is also known as an independent collateral. Parties exchange variation margin on a periodic basis during the term of a derivative contract, as typically specified in the variation margin agreement or by regulation. Variation margin offsets a change in the value in market value of derivative contracts and thereby covers the potential loss arising from the default of a counterparty. Variation margin may not always be sufficient to cover a party's positive exposure due to delays in receiving collateral or other reasons, and thus parties may exchange initial margin. Parties typically exchange initial margin at the outset of the derivatives contract and in amounts that are expected to reduce the likelihood of the positive exposure amount for the derivative contract in the event of the counterparty's default, resulting in overcollateralization. To facilitate the exchange of collateral, parties may enter into variation margin agreements that typically provide for a threshold amount and a minimum transfer amount. The threshold amount is the maximum amount by which the market value of the derivative contract can change before a party must collect or post variation margin. In other words, the threshold amount specifies an acceptable amount of under-collateralization. The minimum transfer amount is the smallest amount of collateral that a party must transfer when it is required to exchange collateral under the variation margin agreement. Parties generally apply discount, known as a haircut, to non-cash collateral to account for a potential reduction in the value of the collateral during the period between the last exchange of collateral before the close out of the derivatives contract, as in the case of default of the counterparty, and replacement of the contract on the market. There are two general elements of the counterparty credit risk. The counterparty credit risk CCR, or default risk that we are talking about here. If a transaction has a positive value, what is the risk that a loss occurs before the final settlement with the defaulting counterparty is the question for that category of risk. It is driven by market value and counterparty's probability of default. The second type is credit valuation adjustment, or CVA, or market value of expected CCR. It's actually convenient to think about CVA and CCR in the context of what's being measured here, and we like to use this shorthand of referencing to CVA as ultimately pricing of the CCR. CVA is asking the question, what is the risk that a positive value of a trade deteriorates because the counterparty credit risk deteriorates without a default? CVA is driven by market value and the counterparty's credit spread. So how it all relates to the topics of today's conversation, SA-CCR. SA-CCR is a new methodology for calculating the exposure amount of derivative contracts under the agency's capital regulations and provides important improvements to risk sensitivity and calibration relative to the existing current exposure methods. You probably have heard the term SAM. In addition, SA-CCR is less complex and model-dependent than the internal models methodology that can be used by advanced approaches banking organizations subject to regulatory approval. Under the final rule for non-advanced approaches banking organization, SA-CCR is available as an option to SAM because the implementation of SA-CCR requires internal system enhancements and other operational modifications that could be costly and present additional burden. And non-advanced approaches banking organizations that elect to use SA-CCR must use SA-CCR to determine the trade exposure amount for its clear derivative contracts and for purpose of calculating the risk-weighted asset amount of the default fund contribution of a central counterparty or qualified central counterparty. The federal bank regulatory agencies jointly issued a final rule on November 19, 2020, although it was published in the Federal Register somewhat later. The effective date of the final rule is April 1st, 2020. That means that early adopters can start to use SA-CCR starting from April 1st, 2020. The mandatory compliance date of the final rule is January 1st, 2020 for advanced approaches banking organization. As I mentioned before, for non-advanced approaches banking organization, there is a choice of whether stay the same or transition to SA-CCR. The final rule replaces SAM as an alternative method for purposes of calculating advanced approaches total risk-weighted assets under the agency's risk-based capital rules. The final rule also requires banking organizations subject to the Category 1 and 2 standards to use SA-CCR for purposes of calculating their standardized risk-weighted assets. All other banking organizations, Category 3, Category 4, and all other banks using the risk-based capital framework may elect to use either SAM or SA-CCR for purposes of calculating the standardized risk-weighted assets. As noted before, non-advanced approaches banking organization may elect to use SA-CCR or SAM. The final rule also updates supplementary leverage ratio framework to permit the use of SA-CCR in the determination of the exposure amount of derivatives included in a banking organization's total leverage exposure, that is the denominator of the supplementary leverage ratio. Those requirements are applicable for category 1, 2, and 3 banks. The use of SA-CCR allows banking organizations to recognize client collateral in the calculation of the derivative exposures and in the supplementary leverage ratio to the same extent a banking organization might recognize collateral for risk-based capital purposes. Now let's a little bit skim through overall framework of SAM, and SA-CCR just to get the feeling of the differences between two approaches. Under current exposure method, SAM, the EAD is determined as a sum of the current credit exposure and potential future exposure. Current credit exposure means, with respect to a netting set, the larger of zero or the fair value of a transaction or portfolio of transactions within the netting set that would be lost upon default of the counterparty, assuming no recovery or value of the transactions. And this part I would like to attract people's attention. Current exposure is also called replacement cost. And sometimes in the context of SAM, you will see the reference to replacement cost, while SA-CCR also uses this term, but it has a quite a different definition. So when you hear the term replacement cost, you may immediately check under what approach it's being used, because it may mean a bit of different things. In terms of PFE, for a single netting set, for a single trade, it's quite easy. The determination is 4-step. You determine the asset class, maturity date, then you go to good old table that is in the capital rules, and figure out what going to be that add-on, and then you multiply notional of the trade by the percentage of add-on, and you're done. Things are a bit more complicated for portfolio of trades, but here again it's relatively straightforward. We calculate a gross, the sum of the PFE amount of each individual derivative contract subject to the qualifying master netting agreement, and GR, the ratio of net current credit exposure to gross current credit exposure. Then we figure out gross current credit exposure, which is the sum of the positive current credit exposure of all individual derivatives contracts subject to a qualifying master netting agreement. And finally, the net current credit exposure is the greatest of zero, and the net sum of all positive and negative fair values of the individual OTC derivative contracts subject to the master netting agreement. It is a very straightforward method, and I'm pretty sure that everybody on the call knows very well how to operationalize it. Now let's look at SA-CCR. The inputs for SA-CCR are quite different, and that's what we're going to spend the rest of our time today. The EID under SA-CCR is a product of alpha times the sum of replacement cost and potential future exposure. As we will cover later, alpha typically will be set at the level of 1.4 unless it is applied to commercial end user counterparties. In that case, the value of alpha is 1, or meaning there is no alpha there. Replacement cost captures the loss that would occur if a counterparty were to default and were closed out of its transaction. Multiplier allows partial recognition of excess collateral, and we mentioned before that SA-CCR utilizes netting and offsetting to much larger degrees than SAM. And finally, add-on derived from add-ons developed for different asset classes, and the last two elements in multiplier and add-on result in the PFE add-on. Now let's look at those individual concepts that we covered in the previous slide. Replacement cost generally is the cost of replacing a given contract if the banking organization's counterparty defaults. SA-CCR provides separate formulas for replacement cost depending on whether the counterparty to a banking organization is required to post variation margin for a net asset. And I want to focus on this distinction. SA-CCR is quite sensitive towards recognition of whether a derivative is margined or unmargined. And as we go further, you will see that there are different treatments for margined and unmargined derivatives. In general, when a banking organization records a net positive amount of financial collateral, the replacement cost would be reduced. Conversely, when the banking organization records a net negative amount of financial collateral, the replacement cost would increase. A replacement cost calculation of a net asset subject to variation margin requirement is designed to reflect the maximum possible unsecured exposure that would not trigger a variation margin call. In the net asset not subject to variation margin requirements or the counterparty of the banking organization is not required to post a variation margin, the replacement cost is the greater of either the sum of the fair value of the derivative contracts within the net asset less than net independent collateral amount applicable to the derivative contract or zero. If the net asset is subject to a variation margin agreement such that the counterparty of the banking organization must post variation margin, the replacement cost is generally the greater of the sum of the fair value of the derivative contracts within the net asset less than net independent collateral amount and the variation margin applicable to such derivative contracts, and the sum of the variation margin threshold and minimum transfer amount applicable to the derivative contracts within the net asset, less the net independent collateral amount applicable to such derivative contracts or zero. Overall, replacement cost is the easiest part of the SA-CCR formula. And as we will go further as a deck, you will see that things becoming a bit more complicated quite fast. PFE, potential future exposure. The potential future exposure of a derivative contract reflects the possibility of changes in the value of the derivative contract over a specified period. Under SA-CCR, the potential future exposure amount is based on the notional amount and maturity of the derivative contract. Volatilities observed during the financial crisis for different classes of derivative contracts, and here we have in mind interest rates, exchange rates, credit, equity, and commodity. The exchange of collateral, as I mentioned, we distinguish between margin and unmargin derivatives, and full or partial offsetting among derivative contracts that share an economic relationship. PFE multiplier. PFE is the product of multiplier plus aggregate amount, where PFE multiplier decreases exponentially from a value of 1 to recognize the amount of any excess collateral and the negative value of derivative contracts within the net asset. The aggregated amount accounts for full or partial offsetting among derivative contracts within a hedging set that share an economic relationship, as well as observed volatilities in the reference assets, the maturity of the derivative contracts, and the correlation between the derivative contracts and the reference exposure, long and short. Generally speaking, the offsetting will be applicable within each asset class. And if you go through the rule, you will see that calculations for PFE will be driven by titles of different asset classes. The PFE calculation allows a bank to fully or partially offset derivative contracts within the same net asset that share similar risk factors based on the concept of hedging set. A bank then determines each hedging set amount using asset class specific formula that allows for full or partial offsetting. And that's what I was referencing before. So what are the asset classes that we touched upon in the previous slide. Interest rate contracts, full offset provided for contracts within the same tenor category, and there are 3 tenors present, below 1 year, 1 to 5 years, and above 5 years. Otherwise, partial offset is provided. For exchange rate contracts, FXs, full offset for contracts referencing same currency pair, and there are some somewhat complicated treatment for conversion of currency pairs if multiple currencies are being used. Credit and equity contracts, full offsetting for credit or equity contracts that reference the same entity and partial offsetting when aggregating across distinct reference entities. And finally, commodity contracts based on commodity categories, energy, metal, agriculture, and other, and allows full offset for all derivative contracts within the same commodity category that reference the same commodity type. In other words, you cannot offset your grain, wheat contracts with energy, oil contracts. Now let's go to the example and kind of trying to put this all together in a simple case that we can walk step by step. So we have a netting set that consists of 2 fixed versus floating interest rate swaps that are subject to the same qualified master netting agreement. And I assume that audience is familiar with the concept of the qualified master netting agreement for the purpose of their ISDA agreements and other purposes. So our 2 derivatives, derivatives number 1 is interest rate swap with a residual maturity of 10 years and that pays a fixed leg, has a notional of $10,000 and fair value of 30. And the second derivative is interest rate swap with residual maturity of 4 years that pays floating leg, again the same notional of $10,000 and fair value is minus 20. The netting set is subject to variation margin agreement, and remember, it matters for us whether there is variation margin or not, so in this case we assume that it is. And the banking organization has received from the counterparty, as of the calculation day, variation margin in the amount of $10,000 and initial margin in the amount of $200,000. And both the variation margin threshold and the minimum transfer amount are 0, so we will just assume that they don't exist. That will slightly simplify our calculations. First, let's do the easy step, figure out the replacement cost. The replacement cost of a netting set subject to a variation margin agreement would equal the greater of, as you remember, the sum of the fair value after excluding any valuation adjustment of the derivative contracts within the same netting set, less the sum of the net independent collateral amount and the variation margin amount applicable to such derivative contracts, or the sum of the variation margin threshold and the minimum transfer amount, I shouldn't say or plus, applicable derivative contracts within the netting set, less the net independent collateral amount applicable to such derivatives, and 0. So putting it all together from our previous table with the data, we have 30 minus 20. This is our value, 200 plus 10. We, as I mentioned, we don't assume that minimum transfer and threshold are set at 0. So after we all we add up all this all together, we are receiving the replacement cost of 0. So we are done with the first part of the SA-CCR formula. Now we have to deal with next more complicated step is determine the potential future exposure. And here we're going to spend a bit of time. In order to determine, first we need to figure out the adjusted derivatives contract amount, and in order to do that, we need to determine the adjusted notional amount. The adjusted notional amount has a somewhat complicated formula, but I wanted to attract your attention to parameters S and E. The number of business days from the present day until the start date for the derivative contract, or 0, and E is the number of business days from the present day until the end for the derivatives contract. Those two values are handy because they will allow you to figure out the residual maturity of a contract. So now we again just purely plug in the numbers in the formula, and we have the same notional but different tenors, and we get our adjusted notional amounts of 78,694 and 36,254. After that, now we need to look at supervisory delta adjustments. The supervisory delta adjustment accounts for the sensitivity of a derivative contract scaled to unit size to the underlying primary risk factor, including the correct sign, positive or negative, which accounts for the direction of the derivative contract amount relative to the primary risk factor. Derivative contract 1 is loan in the primary risk factor and is not an option, and being an option matters a lot in this context. Therefore, the supervisory delta equals 1. Derivative contract 2 is short in the primary risk factor and is not an option, therefore the supervisory delta is equal to negative 1. So let's remember that we're going to need this information that our supervisory delta for swap 1 is 1 and for swap 2 is minus 1. We keep going with PFA calculations, and now we need to determine the maturity factor. Assuming a margin period of risk is 15 days, we again plug in 15 days into the formula and obtain the maturity factor of 0.3674. Now we can look at the supervisory factor. Supervisory factor reflects the volatilities observed in the derivative markets during the financial crisis and reflects potential variability of the primary risk factors of the derivative contracts over a 1-year horizon. The supervisory factor for interest rate derivatives contract is 0.5%, and this is a set value, and if you go to the row, they're all going to be listed in a table. So at this stage, we determine the adjusted derivative contract amount for both swaps, which is 144.57 for swap 1 and minus 66.60 for swap 2. After we've done this set of calculations, we go to the next step. We are ready to determine hedge and set amount. We plug in the numbers from slide 23 that we just discussed into the hedge and set formula and obtain the hedge and set amount of 108.89 cents. This is probably the easiest part of the presentation. Because the net and set includes only one hedge and set, the aggregate amount is equal to what we calculated before. The hedge and set amount is 108.89 cents. If you're still with me, we are getting close to finish our PFA calculations. Now we can determine the PFA multiplier by using data from slide 25. And we, again, do a plug in the formula of value and collateral and adjusted amount that we calculated before and get our PFA multiplier. And finally, we are ready to figure out what is our PFE. Once we know the PFE multiplier, we can determine the PFE, which equals the product of the PFE multiplier and the aggregated amount, and in our case, that is $44.79. So where we are with this? After all those steps, we finally can figure out what is our EAD for our two derivatives at the SA-CCR methodology. The exposure amount of a netting set would equal the sum of the replacement cost of the netting set that we determined in slide 17 and the PFE of the netting set that we determined in slide 27, which are multiplied by 1.4. So putting it all together gives us the number of 62.70. If those swaps are entered into with counterparties which are commercial end users, then the value 1.4 turns in 1, and as a result, the EAD will be 44.79. So if I haven't put you asleep yet, let's look at some other provisions of the rule that deal with counterparty credit risk. I mentioned a number of times right now that the rule introduces the concept of commercial end users. The final rules provides relief to commercial end users by removing the alpha factor for exposures between a banking organization and commercial end users. For most derivative contracts, the alpha vector equals 1.4. However, no alpha factor applies to derivative contracts with commercial end user counterparties. I know that we received some questions about commercial end users, and I will talk about it in more details later. But as a general comment, commercial end user definition has been used by Commodity Futures Trading Commission for quite a while, and the definition adopted in the SA-CCR largely is consistent with the definitions that are present in the margin requirement under prudential framework, as well as the CFTC commercial end user requirement. There are variants where there are differences, but generally speaking, those two concepts are going to be quite close. Other elements that I would like to flag that are present in the final rule. The final rule also incorporates SA-CCR into the determination of exposure amount of derivatives for total leverage exposure under the supplementary leverage ratio and clear transactions framework under capital rule. I touched on supplementary leverage ratio calculations before, which apply to category 1, 2, and 3 institutions. And the key element here is that for the purpose of recognition of client margin, client initial margin, the supplementary leverage ratio provides special rules. In terms of clear transaction framework and the capital rules, you should be familiar with old framework of CCPs and QCCPs and trade exposure and default fund calculation. And the final rule effectively takes the concept of SA-CCR and puts it in this construct of trade exposures and default fund contribution. Further, the final rule makes technical amendments to the capital rule with respect to clear transactions, and there will be also some special provisions related to settled to market versus collateralized to market transactions. That completes the formal part of the presentation, and now I will turn to Angela to collect any questions that we received. And as I mentioned, we already got some questions beforehand, so let me start to address them. So one of the questions I see is how SA-CCR will be applied to supplementary leverage ratio. So let me spend a little bit of time on this question so we all have a clear understanding who's going to be in the scope here and how implementation will look. The final rule updates supplementary leverage ratio framework to permit the use of SA-CCR in determination of exposure amount of derivatives included in banking organizations' total leverage exposure. And if you remember the formula, it will be the denominator of the supplementary leverage ratio. And as I mentioned before, the use of SA-CCR allows banking organizations to recognize client collateral in the calculation of derivative exposures in the supplementary leverage ratio to the same extent that a banking organization may recognize collateral for risk-based capital purposes. I want to emphasize this. The final rule requires Category 1 and Category 2 banking organizations to use SA-CCR, and Category 3 banking organizations are provided an option to use SAM or SA-CCR in their supplementary leverage ratio. But like in a risk-based case, is the same is true here. If a Category 3 banking organization chooses to use SAM to calculate the total risk-weighted assets, it must use SAM to determine the exposure amount of all derivative contracts for purpose of supplementary leverage ratio. And the same optionality is present in the context of when you use SAM or SA-CCR for non-advanced approach banking organizations for risk-based capital. It's the same principle. You use it for follow-on for nothing, and it's designed to eliminate cherry picking. I'm looking at the question here that we just received. To apply netting under this methodology, must the institution elect netting per accounting policy, or can an institution apply the netting even if the accounting election is not made? I assume the question is dealing with hedging, and netting is applied to hedging requirements under U.S. GAAP. So backtracking a little bit here, as we discussed before in SA-CCR PFE methodology, the kind of the first requirements that you need to ensure is your derivatives are subject to the same QM&A, qualified master netting agreement. And following that, you will have an asset class specific netting and offsetting provisions, and the methodology gonna differ a little bit for different asset classes. So I think based on your question, the answer will be you will rely on netting provisions as they are outlined in the final rule. Okay. Another question that we got is to list all the changes that were made in the final rule compared to the proposed rule. You will see an explanation in the preamble of the final rule that there are a number of modifications that were made in order to address a concern raised by commenters. And the rule greatly benefited from comments of a broad constituency of stakeholders. There was a lot of comments from banking institutions, from commercial end users, from non-profit public advocacy groups, academics, and many others. So there are generally, I would say, 4 broad changes in the rule. The first is the final rule changes certain supervisory factors for commodity derivative contracts to coincide with the supervisory factors in the Basel Committee standard. Originally, the energy bucket was compressed in a single one, and the final rule broke it down again in the same manner that Basel standard had it. Second, the final rule removes the alpha factor for exposures to commercial end users. We talked about it. Third, the final rule allows a banking organization to treat settled to market derivative contracts as subject to a variation margin agreement, allowing such contracts to net with collateralized to market derivative contracts of the same netting set. And I already mentioned that the final rule also allows clearing member banking organizations to recognize client collateral under the supplementary leverage ratio to the same extent the banking organization may recognize collateral for risk-based capital purposes. And let me just stop a little bit on the settled to market versus collateralized to market derivatives. Several years ago, prudential regulators, as you recall, issued a guidance that explains the treatment of settled to market derivatives under the capital framework. The general gist of that guidance was that if a cleared derivative, and at the time they were all cleared under either CME and LCH rule book, if the clear derivative and associated rule book introduces the settled to market concept where daily exchange of collateral is not really a collateral but a settlement of the outstanding position, then those contracts can be treated as STM with special maturity calculations, but they should satisfy accounting opinion requirements and legal opinion requirements, and we can find it in the guidance. What was explained in the comment period for NPR is that because SA-CCR distinguishes between margin and non-margin derivatives, it created a bit of a confusion of whether STM and CTM will end up in different categories and won't be able to use to offset each other. And in response to that, prudential regulators allowed contracts to net with collateralized to market derivatives contract of the same netting set for settled to market derivatives, but that would ultimately mean that STM have to be treated as CTM for all other purposes. And one more change that was made in the final rule compared to the NPR is the closeout period required in the event of federal counterparty failure. The final rule provides that MPOR for those exposures cannot be less than 10 business days for transactions subject to variation margin agreements that are not client-facing derivatives transactions. The rule also introduces the concept of client-facing derivatives transactions, that leg of the transaction from clearing member to the client. And in the clearing framework, there are going to be some more or less clarifications about how client-facing derivatives contracts are treated. Okay, so let's try to deal with one more question, where the concept of commercial end users is coming from. As I mentioned, it's not a new concept. Commodity Futures Trading Commission regs have been using it for a long time. And the banking regulators, prudential regulators, margin rule relied on the definition of commercial end user. So this concept that is specifically defined and introduced in the SA-CCR rule generally is mimicking to what was already in the market for quite a while. To operationalize exposure amount formula for derivative contract with commercial end users, the final rule provides a formal definition, And I have the legal references here, so I will run through them. So if people familiar with FTC regs, it will be a bit easier for you to do the comparison. So under the final rule, a commercial end user means a company that is using derivatives to hedge or mitigate commercial risk and is not a financial entity listed in Section 2H7C Romanet I L through Section 7 of the Commodity Exchange Act, or is not a financial entity listed in Section 3C of the Securities and Exchange Act. And again, as a reference, why we cross-reference in both Commodity Exchange Act, that is CFTC, and Securities Exchange Act, that is SEC, is because while swaps and futures and options will be subject to CFTC jurisdiction, security-based swaps and other security-based products will be subject to SEC jurisdiction, and the rule tries to capture both of those prongs. The definition also includes an entity that qualifies for the exemption from clearing under Section 2H7A of the Commodity Exchange Act. Generally speaking, if an entity is exempt from clearing requirements, it's going to be as a rule exempt from margin requirements. And now is like additional, I guess, benefit is that it also will have a special regime for SA-CCR. One point I want to make, because this came up in the comment period, that those entities include so-called conduits or affiliates that hedge commercial risk on behalf of a parent entity that is not a financial entity, and it will qualify as commercial end user subject to those regs that are listed. Okay, we just received another question. Is this ruling only for banks under the advanced approaches, or would it also include banks whose assets are less than 10 billion? This is a great question. So if the bank, I should get backtrack even more. So you recall that recently the agencies finalized so-called tailoring rule. So the capital rules, as we are looking at it for the derivative standpoint here, will contain both SAM and SA-CCR and IMM. The general breakdown is that for Category 1 and 2 institutions for the risk-based capital, you will be able to use either IMM or standardized approach starting from mandatory compliance date in 2 years. As I mentioned, the January 1st, 2022 is when bank Category 1 and Category 2 institutions must use SA-CCR for the purpose of the standardized risk weights. Category 3 institutions have a choice. They have a choice both for risk-based capital as well as leverage ratio calculations. For Category 1 and 2 banks, there is no choice. They would have to use SA-CCR for the purpose of supplementary leverage ratio calculations. And then it leaves everybody else. And everybody else will have a choice of either using SAM or SA-CCR for the purpose of the risk-based capital. I think when you're talking about 10 billion, you are referring to things like TRIPRA amendments or margin exclusions or things like that. Generally speaking, you should not be impacted unless you're Category 1, 2, and 3. And if you currently have derivatives, you would capitalize them either under the current SAM approach or if you want to do so under SA-CCR approach. I guess to finalize this, my long convoluted response to this is that if you're using SAM right now, nothing in this rule requires you to change your SAM approach for derivatives going forward. But it gives you an additional option to choose SA-CCR if you decide so. Okay, we are almost out of time, and I'm looking at Angela here that we have no more questions. That is good. I guess the last point that I wanted to make in the context of SA-CCR implementation, as we went through the PFE calculations, it's I wouldn't say it's a complicated process, but it's somewhat a data-intensive process. So we would expect that banking organizations that decide to go with the voluntarily implementation of SA-CCR will undertake probably substantial revisions to their operational system, IT system, to be able to generate necessary data for SA-CCR calculations. And this is probably a trade-off that people need to be aware that, yes, SA-CCR provides for greater netting and offsetting. That is probably good, but it also requires much more detailed data and much more robust operational systems. SAM is still much more simple compared to SA-CCR. So you may want to kind of do your cost-benefit analysis when you decide which approach you want to use. In terms of our expectations, we generally do not expect that a lot of smaller banking institutions will elect to go with SA-CCR, at least initially, because of this operational data lift that needs to happen. But it doesn't mean that somebody will not decide to do the adoption. It's absolutely up to a banking organization to decide what works the best for it. When we did our calculations, generally just based on the structure of the methodologies, directional portfolios usually do not see that much benefit on a pure numerical level, because there is not a lot of netting and offsetting that can take place. It's usually the balanced portfolios that will more benefit from the new methodology. Okay, and now $1 million question. I missed the introduction. Will this deck be shared with public? I don't know, actually, and I look at Angela, and I think she looks back at me, and we both don't know. So let us figure out the process for this, and if you want to email me, my email is on file. I will respond to you. But generally speaking, it's absolutely consistent with the rule itself. It's more concise version, but again, let me check on this, and I will let you know whether we can share the deck or not. I think usually we do, but I don't know. Okay, Angela gives me scary hand gestures. I think it means that I need to shut up. So, Angela? Operator?
Yes.
I guess we are ready to close the webinar.
Okay. And that concludes today's conference, everyone. You may disconnect at this time.